Hello and welcome to episode 8 of the Lifespan Investment Series. Joining me again is Lifespan Investment Committee member, author and publisher of the Payne Report, Jonathan Payne. Welcome, Jonathan.
Hello, Eugene.
So once again, I think I say this every time we speak, there's been a lot going on in markets, geopolitically in particular, ongoing Trump trade announcements, the resultant market volatility that we've seen, elections in Canada and obviously the election in Australia. So let's talk about Trump first. We're almost 4 months into Trump's second term, as we all know. You and others have spoken about the possibility that Trump's tariffs were more of a bargaining tactic to secure better trade deals and or get particularly the European countries and possibly others to fund more of the defense spending globally. Now that we've seen a little bit of this play out, what do you think of that now, JP?
Well, thank you, Eugene. And I think it's appropriate every time we speak, Eugene, because it's only once every 3 months, that you do say there's been a lot going on. Look, I've been doing this for 41 years, and you know I'm a self-confessed current affairs, news, market data junkie. I can tell you, Eugene, without any hesitation, that this is by far and away the most fascinating time that I've experienced in financial markets. And I spoke at an event earlier this week, and I said that I feel my 41 years in the financial markets has led me to this moment in time, because we are indeed witnesses to a remarkable watershed moment in time. So let's talk Trump. And Trump, in the news not every day, every minute of every day. He loves the headlines, and he is certainly the headline wherever you are in the world. And obviously, if we're talking tariffs, we have to talk Switzerland. And if we're talking Switzerland, it is the remarkable meeting. Now we know more and more detail about the meeting over last weekend between US Treasury Secretary, obviously, and US Treasury Secretary Scott Bessent, assisted by US Trade Representative Jameson Greer, and their counterpart in China, Vice Premier He Lifeng. In fact, he is spelled He, but is pronounced Ha. So it's Ha Lifeng. It looks like the meeting went remarkably well at a personal level in terms of the personal chemistry. We know that because the American delegation told us that afterwards in a press conference, which if any of you have the time, is a must watch. But the bottom line is we saw a dramatic reduction in the tariffs from, if you remember, if you're keeping score on the tariff war, US had 145% on China. China had 125% of the United States. The United States has brought the 145% down to 30%. But actually, if you look into it in greater detail, the net figure is near 40%. I won't go through the arithmetic because there were a lot of pre-existing tariffs, which you remember from Trump's first time in government. Then Biden continued those. And then, of course, Trump came straight in with a fentanyl 25% levy. The bottom line is the discussions went better than anyone anticipated, certainly better than I had anticipated. I thought this was more of a get-to-know-you kind of meeting. The Chinese delegation didn't know or not familiar with Scott Bessent. They were familiar with Jameson Greer, who was actually chief of staff under Robert Lighthizer, who was the key US trade point person in the first Trump administration. The bottom line is they've now got a framework for further discussion, and the punitive tariffs that Trump had imposed upon China have been paused for 90 days as they work through things. Fentanyl was front and center, and anyone who follows the US news cycle will know that fentanyl has been a big issue for Trump, and he's spoken repeatedly about it on the campaign trail and subsequently as well. So there seemed to be some really good traction and progress on that one. But also in a broader sense, it looks like, and I know everyone's asking the question, who blinked first? And in a kind of way, it doesn't really matter who blinked first. My take, and I'll be certainly writing about this in my forthcoming Payne report, is they both blinked because both appreciated that a decoupling of the Chinese and US economies was simply not feasible. And I've been writing about this, and I've asked the question in my Payne report. And by the way, if I can, thank you to many of you at Lifespan who've subscribed recently to the Payne report. It actually makes these conversations so much easier because you know the context of my perspectives and opinions. So there's so much happening. I can keep you up to date through the weekly Payne report. But the bottom line is the United States was in dire straits if it was attempting to decouple from China. Ditto, the Chinese realized that they were in dire straits as well, with 145% tariffs being a de facto trade embargo. So both have stepped back from the brink and acknowledged that the kind of linkages and dependencies between these two economies, the largest in the world, obviously, are something that just cannot be unplugged. They've both come to that realization. So look, what it did for financial markets, obviously we gapped higher in the Monday session, just gone actually. What day is it today? Wednesday. And it removes, I think, at the extreme, the kind of so-called tail risk of a real economic Armageddon. And obviously also somewhat pares back some of the kind of recessionary risks because we'd seen already, Eugene, a significant decline in freight orders and ship movements from China. You know, we have satellites tracking the number of container ships that were moving across the Pacific into the west coast of the United States, and forward freight orders had collapsed, truck tonnage had collapsed, so on and so forth. So the other thing I'll say quickly, and I know we've got to move on to so many other things, there was an incredibly important meeting between the chief executives of Walmart and Target that took place in the Oval Office recently. And both those CEOs of two of the largest grocery supermarket chains stores in the United States really impressed upon Donald Trump that the shelves at Walmart would be not well stocked in 6 to 8 weeks' time. We knew from all the freight data that there was trouble ahead. And also a statistic that I've used repeatedly in my pain reports recently, the one that I've asked every single person to try and memorize, is that 40% of all Chinese goods that come into the United States, 40% of all Chinese imports into the United States are so-called components or inputs into final finished goods. So there are a number of businesses, particularly in the smaller business sector, that were literally going to be wiped out if you attempted to unplug in a single instant the Chinese economy and supply chains from the US economy.
Yeah, absolutely. So it's been interesting to watch it play out. I feel as though the way it has played out perhaps confirms that it was a bargaining type strategy. I'm not convinced that Trump really wants to bring manufacturing back in a massive way. I think it was perhaps more about securing. I know that was his pitch. But when you think about the lead time of building new factories and getting, it's a 5 to 7 year proposition. He's only going to be in power for 4 years. It's a lot of investment in such an uncertain environment. So I'm not convinced that was the real motive behind it. I think it was more about securing trade, and perhaps it's just another tax to help pay for some of the tax cuts that he's promised and will look to deliver, I suppose. And I guess that leads me to the next part. Going back to our last episode, we discussed the potential positive fiscal and market impacts of a Trump administration, which is, what the stock market did. It took off like a rocket after he got elected, focusing on tax cuts and potentially some of the other positives. And then we saw how, as soon as he actually came out with some of these tariffs or proposing tariffs, we saw what happened in markets in March and April. And now that they've been unwound, you can see markets rallying again. So it'll be interesting what happens next. But, is it time to reevaluate, given what's happened, the US as a major economic power over the next 6 to 12 months?
Yeah, it's interesting, isn't it? So, just to emphasize your point, if we go back to, Liberation Day on April the 2nd, when we had the full shock and horror of the scale of these tariffs, particularly these so-called reciprocal tariffs, and we won't get into the arithmetic behind them. You recall that from the February 19th high on the S&P 500, we fell 21%. Into those lows on around, I think it was April the 7th. So it was one of the fastest declines we've actually ever witnessed. Obviously, 87 stands out as a special case, and COVID is another one. But I mean, in terms of since 1929, it was like the third or fourth fastest decline, or so-called crash. If you define a crash as a 20% decline, that's just a numerical number that Wall Street talks about. And then, of course, the NASDAQ fell by even more. And then the really kind of racy sectors, such as the SOX, the SOX, the Philly Semiconductor Index, fell even more, significantly more, in fact. And so from that Feb 19 peak down to that April 7 low, it was a fast and furious decline. And the markets became incredibly oversold. And the fascinating thing that I've learned in 41 years, whenever the markets fall as fast as that, they always bounce every single time. There is, without exception, because the so-called fast money, the more aggressive money, the hedge funds, the CTAs, certainly the algos and others, and even people like myself, the kind of people who trade markets, are getting aggressively short. How do they make money? Is by obviously closing those shorts. So they have to buy back in, and that gives you the bounce. So it was a very, very, very sharp decline. We've now haven't fully erased the decline. Obviously, we're not back at the Feb 19 highs. We're about 4.5% below on the S&P 500. But also, what I find fantastic, and I've been articulating this in my pain report, at times like this, Eugene, I use technical analysis. I probably at a time like this more heavily rely on technical analysis, because the economic data is just noisy and it's real late. I mean, when you have an event such as Liberation Day on April the 2nd, what's the point of even looking at the economic data? Because everything pre-Liberation Day is completely irrelevant. It's only data not even immediately past April the 2nd. It's only data 6 to 8 weeks down the road that we're going to be able to look at. And what we can say right now is, if he had maintained 145% tariffs on China and hadn't, by the way, we haven't even talked about the pause, which Scott Bessent intervened and engineered. If we'd maintained the same tariff levels that he unveiled on April the 2nd, I mean, the soft data, which already was soft, i.e. the so-called survey data, would have certainly translated into not just soft, hard data, we'd have gone headlong into a recession. So that's what we were staring at, and that's what the stock market was telling us. But then Scott Bessent, the Treasury Secretary, intervened. I wrote about this in my Pain report as well. I actually was begging Bessent to go to Mar-a-Lago on the weekend and talk to Trump and say, we need a timeout. And he got a timeout. He got Trump's ear. And this is something I want everyone listening to this recording to understand. Scott Bessent is absolutely critical. I mean, Trump might be the most powerful individual in the world, and Jerome Powell's very influential. I would argue Bessent is right up there. And without Bessent's intervention, we were looking at a very bleak situation. But, Bessent intervened and said, Mr. President, you need to take a time out here because I'm getting all the intel. And because, Scott is a very, very, very accomplished global macro hedge fund manager. So he's global macro, Eugene, like I'm global macro. And he puts that jigsaw puzzle together every day. And what he was seeing was very alarming because we saw, Eugene, if you recall, we had a very unusual event occurring, Eugene. We had a simultaneous collapse in the stock market in the United States, a very sharp rise in bond yields, accompanied by a very sharp decline in the US dollar. But let me just bring the tariff discussion to a reasonably brief close, although I promise you I could talk for days just on that one topic. So the basic universal baseline is 10%. They're not going to budge on. Every country is going to have a minimum of 10%. We had the special deal with the UK, but don't forget we've got a special relationship between the United States and the UK, long-term allies, so on and so forth. China now, we've got a process, a framework for further discussion. We're not out of the woods on the China trade conversation by any means, but we're back from the brink of what could only be described as kind of economic Armageddon. As a consequence, the markets have rallied. Now, the other countries, we know India's well down the road to getting some kind of agreement. India's critical in a geopolitical framework. I mean, we haven't even got time to talk about India, Pakistan, but there was a US intervention, as we know. J.D. Vance and Marco Rubio, the US Secretary of State, intervened there, and so did Trump, incidentally, and just told both sides to just stop. We were very close to something very serious happening, both of them nuclear armed. But anyway, India is coming to the table, and that deal looks like it's going to be not too far away. Japan, things are a little bit slow on the trade discussions. South Korea, ditto. The EU is going to be more complicated. One of the things about Trump, which I think by now we should all know, he's hyper personalized. If he likes an individual and he enjoys the conversation and the back and forth, he'll provide some concessions. We all know, I mean, it's no surprise, he really doesn't like Europe. He doesn't like the European Union, doesn't like what it represents. He's annoyed with Europe. We know that America's stepping back from Europe and asking the Europeans to defend themselves, that the United States is no longer going to be the policeman of the world and not Europe. That negotiation with the EU is going to be more problematic. So this is not the end of the tariff conversation. I mean, this is the early innings of it, but we have to acknowledge that we're in a better place today than we were prior to the meeting in Switzerland. And so the markets, in my view now, are probably going to consolidate as we start getting information about the EU, for example. The European Union trade deal is going to be really complex. And I think Trump is probably not going to drop it, say, to 10% like he has with the UK. So we mustn't use UK as a template because it's very unique. Because also don't forget the UK has a trade deficit with the United States. So let's work that the other way around. The United States has a trade surplus with the UK, one of the few countries where that is the case. The other one, of course, is ourselves here in Australia. And we're going to be reasonably well treated. We'll probably get a 10% tariff on our stuff, but we don't really move the dial when it comes to the kind of global matrix of global trade. So no doubt that where we are today, what is it, the 14th of May, there's a kind of sigh of relief. And as a consequence, markets rallied very, very sharply. But we're now in a situation where we had been very oversold. We're now very overbought. So we're going to probably consolidate. The good news for someone such as myself is the charts really worked in this environment. The charts were forewarning that the market was rolling over prior to the crash. And now on the other way, they were basically saying we needed to rally. We needed to rally. We've unwound the oversold condition in a dramatic fashion. I now think we're going to have some more consolidation.
So when you say consolidation, you feel as though the market's going to trade sideways, or you think there's going to be a bit more of a drop?
Yeah, I think we could actually trade off a little bit in the next couple of weeks or so. The problem with 2025, and I think this is one of the key characteristics of this year so far, is that it's going to require almost a different operating environment because we've got Trump, and it's a highly geopoliticized environment. I know we're probably not going to talk about the axis of autocracy today, but at the end of the day, we've got this global environment where there are so many very, very important geopolitical balls in the air. We've got Gaza, Israel. We've got Ukraine, Russia. Iran is front and center. And I hope all the people listening to this take the time to listen to what Trump said in Riyadh about 5-6 hours ago. Iran is front and center. What do China and Russia think about that with regard to, what might happen next in Iran? So everything is to play for here. The stakes are very, very, very high. But the China Armageddon scenario is now off the table. That what we call that kind of so-called tail risk. So we had first quarter GDP, Eugene, down -0.3. We know why. And again, I explained that in my pain report, the calculus, the arithmetic, because we had that surge in imports front running the implementation of tariffs, and that's subtracted from GDP. Q2 is going to be very, 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 very noisy. But at the end of the day, the United States economy got a real big shock. We saw massive declines in business confidence, consumer confidence, small businesses saying they were in strife. That is probably going to improve now. Yes, that will improve. But I don't think we're completely out of the woods, because the other thing we've got to bring back into play is a Fed that's on hold, I think, for the foreseeable future. And Jerome Powell went to some lengths to say that to us in that recent press conference.
Yeah, and so let's move on to US estimates. So US estimates, US earnings per share estimates for 2025 have fallen sharply following Liberation Day on the 2nd of April. Do you have any, and I think what we're seeing is uncertainty. It's really hard to know. It's one of the most commonly used words for analysts and people trying to project anything. So what do you think about EPS estimates moving forwards from where we are now after everything's been revised down significantly?
Yeah, as you say, the 2025 calendar EPS numbers were brought down very, very sharply. In fact, funnily enough, if you look at a chart of the EPS for calendar year 2025, we're obviously talking about the S&P 500. Yeah. They actually started declining sharply on and around January the 20th, which of course was the day that President Trump was inaugurated. And then, of course, they took another leg down post April the 2nd. They got a really sharp down revision. But then also, don't forget, a lot of companies just suspended guidance. So we were kind of, our roadmap, we were driving in the dark. We were, it's like driving at night and without headlights. And so basically the analytical community kind of threw their hands in the air and said, look, the companies have no idea. They've withdrawn guidance, and they kind of froze. So we had this kind of paralysis amongst the bottom-up US Wall Street equity analytical community. And so now we've leveled off. I would imagine, and I haven't got anything to substantiate this, I would imagine that some of the analysts might say, hang on a minute, it's not as bad as we feared. But the other interesting thing, Eugene, that 2026 earnings kind of stayed reasonably firm, which I thought was a little optimistic after April the 2nd, when we've seen the size of those tariffs that Trump was threatening to implement. So right now, I really don't have a clear guide for me on EPS. Probably the downward revision is about right for what we have at the moment. But at the end of the day, we have got so many moving parts here. And again, we've removed that tail risk, which was evident with the declaration on Liberation Day. That is out of the way. And that is why markets rallied to the extent they have done. I think now we kind of wait for the next catalyst. And I don't really know what that catalyst is. I think one of the things we need to keep our eye on, which we have done, obviously, Eugene, as you know, for a long time now, is the bond market, because bond yields are moving up again. And the 30-year bond yield in the United States is now touching back at, 4.9%. So back towards the old high. So keep an eye on that as well. And that will be a headwind, I think, for equity markets. So right here now, I'm kind of looking for a period of consolidation. When you get these massive declines, well, a crash in a couple of weeks, followed by a massive rally, you tend to bump around, because all the implied volatility in markets, which, as you know, the VIX went to 60%, and then it crashed back down. And so now we're just going to bump along as the market tries to recalibrate what on earth just happened. And also, don't forget, the tariffs on China have been suspended, not eliminated. So we've got a 90-day window here where there's going to be rhetoric from both sides. So I'm afraid, and I have the right to say this, I'm kind of neutral here in the next couple of weeks and months, because we've seen just such a spectacular decline, and then followed by an equally spectacular rally in markets.
Yeah, and I think if you look at valuations, the US markets are still expensive, particularly for the growth, like post the rally.
Yes.
They were even expensive after the drop. Not expensive, but they weren't cheap on a valuation basis, especially if you consider revised earnings. Isn't that astonishing that companies won't provide guidance? You can understand why, but if companies have no idea as to what their own house is going to do, it makes it pretty hard. But you just got to be diversified, nimble, and listen to what's out there and watch what's going on. All right, let's move on. So it's obviously a difficult period being an investor, and that's where we have to bring out a lot of the tools that we have to manage risk. Because markets hate uncertainty, I think, more than anything.
Yes.
And that's what a lot of this has done. And it could be that who knows what's going to happen after the 90-day freeze. I imagine they're going to look to try to negotiate outcomes so that somewhere before the end of that 90 days, the market can look at it and recalibrate based on information that's known or frameworks that are mostly known. Let's move on to US inflation figures, which came out last night, I think it was.
Yes, it was. Yeah.
In your view, JP, what do you tell us about them? If you could talk us through the release, and then what you think the impact will be on interest rates, and then how will the uncertainty around the trade tariffs potentially impact the appetite for a rate cut?
Yeah, sure. Okay. Well, the actual numbers were pretty boring in a way, but kind of boring inflation data is actually probably good news. So the actual month-on-month number for the month of April, this is headline CPI, obviously rose 0.2, fractionally below consensus. And that brings year-on-year inflation to 2.3%. The previous month, the year-on-year rate was 2.4. At the core level, that's obviously CPI excluding food and energy. We saw on the month-on-month basis up 0.2, fractionally lower than consensus. And the year-on-year rate actually at 2.8%. And that's the one that the Fed kind of spends a bit more time looking at, is the core rate. And that 2.8% at an annual rate is equivalent to the prior month. So, looking inside the numbers, if you want some spectacular headlines, we saw a plunge in egg prices. But don't forget, of course, and as you know, Eugene, Trump loves talking about egg prices. They went sky high. And now, of course, they're coming back down. Let's not dwell on that. But at the end of the day, I'm not going to get too excited about this monthly report. And also, there wasn't too much evidence that we saw the impact of tariffs. That still lies ahead of us. Because don't forget that a lot of these tariffs, okay, let me just say this to step back. Some people are getting a little bit too excited that we might get the impact of tariffs on CPI in this, April report. We're going to get it more in May and June. Why? Because most companies bought or overbought a lot of inventory and filled their warehouses with goods, and they're still selling down those goods at the pre-tariff levels. So we're not seeing the transmission yet into consumer prices. So consumer prices are what's in the shops, not in the warehouses, not at the dock side. So it's further down the chain.
Thanks.
So the one thing I will say, and you've got to be a bit of a data junkie, and I don't know how many of you will remember, I love talking about base effects when it comes to inflation. It's a bit wonky, but that's me, I'm afraid. Now, the next couple of months are going to be really interesting for CPI, because in May last year and in June last year, we had 0.0, 2 successive months. Therefore, moving forward, any kind of rise above that level, you're going to start seeing a disproportionate impact on the so-called year-on-year rate. So watch out for that. And those next couple of CPI numbers are going to capture more of the tariff impact. Because let me just take a quick step back. We all got mesmerized by the 145% tariff that the United States imposed on China. That was just ridiculous. That was, I think everyone agreed, was a de facto trade embargo. There is no trade between the United States and China with 145% tariff. That's why everyone was screaming about it. However, just say we end up at 30%, which is where we are, according to Besant and Greer. But if you add in the previous tariffs, it's actually around 38 to 39%. That is still a very, very high tariff. It's just that what we do in markets is we become desensitized to numbers. We kind of got used to, oh my goodness, 145. So he cuts them down to 30. We all go, oh, happy days. But actually, that's still a high tariff. That is still inflationary. And the other word, which we know is being bandied about, and I'm the one using this word a lot, is stagflation, that combination of upward pressure on prices and downward pressure on the economy. I think the United States economy has all the hallmarks of a stagflationary environment, which makes you more cautious. Why? Because all of us in the financial markets have been raised to anticipate and expect and demand a so-called Fed put. Guess what? There's no Fed put. Powell is not in the mood to save markets, as every central banker has since 1980, since Alan Greenspan. There is no Fed put, because the Fed is looking at the stagflationary composition or makeup of the data. They don't like what they see. And also, we know, Eugene, and this is important, Powell told us time and time again, I don't know, we don't know, I don't know, we don't know, we simply don't know. That he kept repeating that in his press conference, because we don't know what the impact of these tariffs will be, because we don't know what they will end up being, and we don't know the timing. Therefore, you're running the central bank. How on earth do you make decisions around monetary policy when actually all your dials, your economic dials, are kind of giving you crazy readings, not certainly giving you accurate readings yet? And so the Fed has basically told us they're going to pursue a reactive monetary policy. This is important. It's not going to be proactive. When they cut rates three times last year, there was a 50, 25, and a 25. They were being proactive because they saw the unemployment rate rising. here in 2025, notwithstanding that Trump, as you know, has been telling Powell he needs to be cutting rates. He's called him a total stiff. He's called him a fool. He's called him too late, Powell. Notwithstanding all of that, Powell is digging his heels in. And if you listen to his press conference, I've never heard a Fed chair repeat the phrase, "we don't know," so many times. So that means the Fed's reactive. That means they're not cutting rates. They're not raising rates, but they're not cutting rates. And that means the market has had to push out the first rate cut. And some Wall Street strategists are saying it won't be right till the end of the year. So the bottom line to all of that is the Fed is not your friend here and now. And the other issue we need to think about is the bond market is not your friend either, because the bond market is now reacting to this whole new world where foreigners are not buying as much US Treasuries as they previously did. And that's important. That's why Besant has the 10-year US Treasury yield in a picture on his bedroom wall. That's what matters to him. That's what matters to me. We all know it's the most important financial benchmark in the world. But the long end of the US Treasury market is seeing upward pressure on yields. And that's also going to start filtering into the narrative around equity markets as well. So hence why I'm saying we had the collapse. The charts told us that was coming. We've had the rally. The charts told us that was coming. And now it's consolidation and possibly markets saying, hang on a minute, we maybe have overdone this a little bit because, of course, we've got a Fed on hold and we've got upward pressure on bond yields.
Yeah. Yeah. It feels like the Fed's going to be on hold at least until we see a few more months worth of data. When everything is so uncertain, it's hard to see them cutting rates, particularly when a lot of the uncertainty is to the possibility of a shock, an inflationary shock due to tariffs. Obviously, you've got the prospect of a recession, which could perhaps counter that a bit. But if there's no immediate need for him to cut rates, it's hard to see a rate cut, at least until there's more certainty. Let's now, I know we've already talked a bit about China, but looking a bit more closely to the proposed China tariffs and Trump's strategy here, do you think the US has overplayed its hand and underestimated the strength of China's bargaining position? Some believe China now hold all the cards with new trading relationships forced by tariff roadblocks. Now, we've also seen that there's been some horse trading, right? So both sides, as you said earlier, seem eager for there to be a deal because they both stand to lose a lot. So, I mean, yeah, do you think the US overplayed its hand a little bit? And how do you see this evolving over the next few months?
Yeah, this is an interesting point, isn't it? Coming back to the conversation right at the outset about who blinked first, my take, and it's my opinion, obviously, is they both blinked. They both realized they'd walked themselves into untenable situations that was going to do catastrophic damage to their respective economies. So these were two groups of people coming together because they needed to have a conversation. Both parties acknowledged that what they had in place would lead to a massive, massive disruption for the two largest economies in the world. So this was a meeting of minds, an acknowledgement and a recognition that there was catastrophe down the road, economic Armageddon down the road, because you cannot unplug the second largest economy from the largest economy overnight. You said it yourself. It takes years and years to build a factory, years and years and years and years. So to say that suddenly the United States would be self-sufficient in all the things that it got from China, or every small business or every large business in America would simply pick up the phone, find a factory in Indonesia or Malaysia or Vietnam and reconfigure their supply chains. And by the way, those relationships have taken place, they've taken decades to build, is simply ridiculous. So that's why I kept saying in my report, you can't just unplug the Chinese economy from the US economy. It's completely unrealistic. And Besant got that message across to Trump. And just talking about China, because it's really important, notice how Peter Navarro has been sidelined. Peter Navarro was on TV giving interviews every day, and every time he opened his mouth, the Dow fell 1,000 points. Yeah. Now, I know a lot about Navarro. Anyway, he wrote books in 2001, et cetera, et cetera. So the fact that the focus is on Besant and also that the chemistry in the room, I just want to emphasize in the press conference, Besant used the words mutual respect. Now, any of us who've watched China, been a China watcher for more than 3 decades. The one thing when in a negotiation or conversation, any kind of discussion with the Chinese is you've got to demonstrate mutual respect. If you come in there, kind of, we're the United States of America, we've got all the cards in our hands, there is no conversation, there's no deal. Besant went to some length in the press conference in Switzerland talking about the amount of mutual respect and how well prepared the Chinese were. Now, you may well have seen, Eugene, I have to get this in. by the way, they had already met secretly in the basement of the International Monetary Fund. You know, the IMF had their meetings several weeks ago in New York. Well, the finance minister of China and the US Secretary of Treasury, Scott Bessent, met secretly in a basement in the IMF building. So when the Chinese kept saying, we haven't made any phone calls, because Trump kept saying there's conversation, discussion, and everyone said, you're not telling us the truth, because the Chinese are saying there's no discussion between China and the United States. The Chinese were being literal. There was no phone conversations. They had met face to face in a secret basement in the IMF building. So there had been quite a bit of preparation going into that weekend meeting. But the bottom line is both parties were adults. They acknowledged that what was going on, namely 145% US on China, 125 China on the US, was simply untenable, unsustainable, and would be a catastrophe, not just for the United States and China, but for the global economy. And so in Switzerland, and by the way, most of the conversations took place under a beautiful tree in the garden of the Swiss embassy, and apparently they got on pretty well. And they basically said, listen, we've gone too far. Let's step back. It's like, it's like the reconciliation of a couple, which is, always nice to see, where people say, you know what, I got a bit silly. Let's take a step back and let's actually start sitting down and having a conversation. So I think both sides blinked and fortunate, and it's very fortunate they did, because by the way, there was all kinds of geopolitical vibrations and ramifications from this, because as some speculated, if one of the stories about China and Taiwan is, why would China ever try and do anything with regard to Taiwan? Because they would lose their trading relationship with the United States, right? That was one of the arguments. Well, China had just lost its trading relationship with the United States. So that then opened the door geopolitically for them to be more assertive in their backyard. And so that recognition was dawning upon the United States as well. And so there was a lot of reasons, there were many reasons for them to come to the table. And I think, overall, I think it's quite good news.
Yeah, good. So we've talked a bit about the US-China trade talks in Switzerland last weekend. We've also mentioned the US-UK trade deal, but do you have a quick comment on that and whether or not this could be a template for trade deals with other countries?
Yeah, there's a very special relationship. I don't need to bore anyone. We all know the relationship between the United States and the United Kingdom. They're bound by treaty. They're one of the, if not the closest relationship of any two nations, particularly within the Western alliance. So it was always going to get special treatment. Incidentally, it's very interesting, this. And again, in a Trump presidency, you need to understand his personality, and he's hyper-personalized. So he actually genuinely, sincerely likes Sir Keir Starmer, which has surprised many people. Even people in the Labour Party in the UK are saying, hey, you're meant to hate Trump. We hate Trump. No one likes Trump. And Keir Starmer said to them, hey, I actually like the guy. We get on really well. We have productive, constructive conversations. And when you meet him, he's a really charming guy. I'm getting on well. Why don't I take advantage of that? And so there was that aspect to the bilateral trade deal. No, I do not think we can use the United Kingdom as a template. That's probably going to be the best deal for anyone. We might get quite a good deal because we're not a threat in any way. We actually, as I said earlier, we actually have a trade deficit with the United States. And the big message out of 2025 is that the primary adversary for the United States is China. And most of this tariff strategy around the world is designed in a way to focus attention on China. Just a quick footnote. I think it's well known that I can only talk on behalf of the Western Alliance. Within the Western Alliance, COVID was a massive wake-up call as to our vulnerability to certain critical goods and the supply of goods. It was a massive wake-up call, and it demonstrated and highlighted and really illuminated the vulnerability of so many of our economies. I know these conversations took place in Canberra, they've taken place in Washington and London and right across Europe. But at the end of the day, you cannot be so reliant on a nation which has been described in your foreign policy documentation as an adversary. Therefore, what Trump is doing with regard to the United States is to make it more self-reliant, more resilient. So that's the big message. And by the way, the Brits are doing the same thing in the United Kingdom. They just go about it in a different way. The way Trump does it is in a slightly more kind of dramatic way. But at the end of the day, the conversations amongst all of the Western Alliance nations is that we cannot be so reliant and dependent on China. I'll give you one area, just one, and there are many, many. You look at critical minerals and rare earth materials. 90% of rare earth material are supplied by China. And some of these critical magnets that are used in military capacities, the great majority of them come from China. And by the way, there was specific conversation about those types of critical minerals and also rare earth materials in the conversation in Switzerland. And this has been a conversation. I've had this conversation with people in Canberra going back. I'm going to go back 10 years, where many of us have identified that China provides 90% of all of the world's processed rare earth materials. Why? Because we all gave it up because it's highly polluting and highly toxic. And so we take all our rare earth materials from the United States and from Canada and from Australia, and we send them all to China. They process them because we didn't want the environmental impact. And this exposed us. This made us very vulnerable. This was actually, and I've said this, has been our Achilles heel, not just for Australia, but the whole Western Alliance. And so all of these things were on the table in Switzerland. Both sides appear to have had a mature conversation about it. And Bessent highlighted, he said, we, the United States, do not want to decouple from China. The subtext to that is we cannot decouple from China. That's the message I had.
Thanks for that, Jonathan. Moving on closer to home, 2 weeks ago, or almost 2 weeks ago, Australians went to the polls and resoundingly endorsed another term of government for the Albanese Labor Party. Quite a significant majority they won with, and I think there were a lot of people projecting a minority government, but obviously that's far from the case. So what impact do you think the somewhat stabilized inflation rates combined with talk of interest rate cuts had on the outcome of this election? And do you also think that anti-Trump sentiment played into the hands of the incumbent government, with Australians seeking stability and transparency in terms of economic and social policy?
Yes, I love predicting election results, particularly US election results, but I didn't predict the Australian election result. A number of my subscribers wrote to me asking for a prediction, and I refused to give one. If I'd been forced to make a prediction, I would have said a small Labor win, possibly a minority government. I was kind of in that. I had nothing to add to the conversation. I didn't spend a lot of time on it. So I never actually even made a prediction in my pain report. I, of course, was surprised at the size of the majority. I agree with you. The anti-Trump, that post-Liberation Day, as soon as Liberation Day happened in the United States, you just saw, a lot of anti-Trump sentiment around the world. And Dutton, rightly or wrongly, got caught up in that. Plus the Liberals. I mean, let's just be frank. I'm sure the Liberal Party's not listening to this. The Liberals, their electoral campaign was simply diabolical. Anyway, we had two. I hate to do these things, but this is just my opinion. You can all shoot me if you want. I think it was one of the most uninspiring elections I've ever really seen, with two very uninspiring candidates, if I may say so. So I'm being rude to both sides, so you can't hate me. Okay, what are the fiscal consequences? Well, as we know, this Australian government has been spending a lot of money, and we know that the size of government's been increasing, bureaucracy's been increasing, a lot of government jobs been increasing. I don't see any change to that. So I think there's going to be fiscal pressures, and I think the bond market's kind of sensing that. If you look at the Australian government bond market, you're seeing yield at the longer end beginning to nudge upwards, being driven partially also by the United States. It looks like everyone's converged around the RBA cutting at this next meeting. I'm not going to quibble with that. I kind of see the argument. Inflation's kind of decelerated, but there's going to be fiscal pressures, I think. So I'm kind of ambivalent. But at the end of the day, look, I suppose the good news is a large majority means kind of relative policy certainty. So that can be construed as relatively good news. Obviously, if you're a Liberal Party supporter, I don't know what you do here. I mean, that was a diabolical campaign. Maybe the Liberals deserve to lose for being so incompetent in terms of their campaign. But here we are. We've got a very large majority for Albanese, and as we all know, the Greens have been wiped out in the lower house. So the Labor Party can put through pretty much any program they want, and one would think that that's going to have quite a lot of fiscal stimulus. They're going to address housing. They made this pledge to increase affordable housing. I think the numbers are quite large on that front, and there's other elements of fiscal spending. So I think Michelle Bullock at the RBA will be looking at this and going, "Whoa, hang on a minute." That she was already a little bit critical about excessive fiscal stimulus. And now she's going to say, well, they've got the mandate now to continue that fiscal stimulus. And I think that's what the Australian government bond market is picking up. So I wouldn't get too carried away celebrating the size of the majority that the Labor Party has, purely from a bond market and fiscal policy perspective. So, yeah, I mean, it surprised me. Luckily, I didn't make a prediction. I would have predicted a Labor win, but I kind of felt it was going to be relatively small. Yeah. The size of it really, it did surprise me, Eugene. You're right.
And so in terms of the impact, to sort of summarize what you said, if I may, in terms of the impact on markets, inflation, interest rates, the fiscal stimulus is probably likely to be on the inflationary side, which may convince the RBA to slow down rate cuts. I think there's a lot of people and a lot of banks predicting a rate cut at the next meeting. Probably, and I think the large majority perhaps on the one hand, you could say it empowers them to go out and do things. On the other hand, you could say, well, they've got such a good majority, they don't have to really do anything to stay in power. But by the way, I agree with you with what you said about both sides being uninspired. I've never paid less attention to an election. I think, not that I'm that political, but yeah, neither of the leaders or the parties for that matter inspire much. So yeah, but stability, like, sorry, it is, I suppose, good to have a majority government, according to some, because it means things can get done.
Right.
Takes a bit of power away from the independents, in a sense, and that can be a good or a bad thing. And you touched on it being stable, because I think people think they know what to expect, given that it's the second term. So look, swings and roundabouts, but I guess it remains to be seen. And yeah, probably more inflationary than a Liberal government would be, which means we may not get the sort of aggressive cut rates that some are predicting 100 basis points by the end of the year, which I think is pretty optimistic, but we'll see. We'll see.
Yeah, I would agree with your assessment there, Eugene. I do think the RBA cuts at the next meeting. We've got one in May, haven't we? We've got one this month, I think. Yeah. So I think you're right. They do cut. And then I think the RBA, it's the positioning statement that follows that. You know, it's what Bullock says after that. Because I think that's kind of, I don't like using words like slam dunk, because nothing's kind of certain in life. But this one has got a high probability of happening, i.e. a rate cut. And then I think RBA kind of goes on hold. But don't forget also, because the Fed is on hold as well. And so I think the RBA will be waiting to see the kind of fiscal agenda and the kind. I think that the RBA is keeping quite a close eye on the bond market as well, the long end of the curve, which is basically saying there's some upward pressure there. So yeah, I pretty much agree with the way you've just described the RBA and the path forward. I at this point wouldn't see 4 further rate cuts. We've had one. We get another one this month. I don't see significant further rate cuts, actually. I think there's going to be more of an extended pause in terms of monetary policy.
Okay. Yeah, that seems to sound more logical to me, but yeah, I've heard some differing views there. So let's see what happens. Let's now have a discussion about our views, or your views, Jonathan, on equities and bonds, which we've kind of already touched on. So let's first start with equities. I think you said earlier you believe in the short term we've got a period of consolidation, which generally means markets will trade sideways, maybe with a little bit of downside volatility. We talked about the fact, I suppose, or the notion that PE ratios and valuations on stocks are pretty stretched. They're still pretty stretched. They were stretched before the drop, a bit more stretched before the drop, but then we've had downward earnings revisions since. So, you know, what's your sort of outlook and positioning on equities globally, and then possibly in Australia?
Yeah, I would net. I would still be somewhat defensive on equities. I think that, you know, that massive decline, then the rally, it happened very, very fast. So I kind of understand. I think a lot of investment institutions, I've actually spoken to people on both sides of that trade. The kind of fast money hedge fund community were very aggressive. A lot of institutional investors just went, whoa, that's, you know, they took a step back, and the market fell so fast. I mean, we nearly had trading limits, you know, circuit breakers on 2 consecutive days. There were 2 days really where this thing really fell apart. And then I think people were kind of saying, okay, we have to reassess the situation. Then the markets just bounced back. I think your observation about valuation is very important. The valuations are still have to be, it doesn't matter if you're a bull or a bear. If you look at history, the price earnings multiples in the United States are still on the expensive side of their, you know, their long run average. So that's an observation of valuation fact. The earnings side of the equation, we've seen that sharp downward revision for EPS, earnings per share estimates for calendar 2025 for the S&P 500. And we're probably going to stabilize around these lower levels in terms of earnings EPS numbers. And so there's kind of is EPS going to be revised up sharply? I don't think so, because now the Fed's on hold. The other thing, which we never talk about in the US anymore, is the housing market. The thing is almost frozen. You know, that's a big engine room, which is really flat and very quiet, actual housing activity. The other thing is, did you know that tourism is 10% of US GDP? I did not know that. That's a really big number. A lot of people from all over the world travel to the United States. And we're seeing a lot of bookings come off, holiday bookings, flight bookings, so on and so forth. Now, we know that tourism from Canada to the United States has collapsed because Trump was ridiculous by declaring that Canada should become the 51st state. I wrote about that in my report. I mean, that was just nonsense. You can understand some of what Trump is doing, but just to declare Canada as the 51st state of the United States, I mean, no wonder the Canadians got upset with him. I mean, what a big surprise. And by the way, Trump put Carney made Carney prime minister, the Liberals were 25 to 30% behind the Conservatives in the Canadian election until Trump started talking about Canada as the 51st state. So what I'm trying to say is there's a huge collapse in tourism from Canada to the United States. These are very big, powerful trading partners, and a lot of damage was done to that relationship. You know, in Canada, I have friends in Canada, they were going to their local store and going to supermarkets, big stores, and the owners, the proprietors, were removing US produce from the shelves. It was serious. Now, some of that will die down a little bit, but then there's also the European-US relationship as well. So at the end of the day, we've got to take a little bit of a step back here and say, hang on, some damage has really been done by Trump unveiling Liberation Day tariffs, but also his rhetoric around Canada, his rhetoric around Europe, declaring, and I listened to the speech because when I read it, I thought I have to hear him actually say it. He declared that the European Union was created to rip off the United States, to take advantage of the United States. And then he said, and they've done a really good job of ripping us off. Now, that kind of rhetoric kind of angered Europe. And we know what the Europeans are doing in terms of NATO. They're increasing defense spending. And there is a sense amongst the global pension fund community. This is important. We know that the Europeans massively increased their exposure and investment to US assets, financial assets, particularly equities, in the last 5 to 7 years. The numbers are dramatic. Many trillions of dollars flowed from European long-term, long-only institutional investors into the United States because we had the Magnificent Seven, we had US exceptionalism. And if you look at the capital flow data, the portfolio flow data, the numbers are staggering. I think, don't quote me, $7 trillion increase in exposure in US financial assets from European long-term investment accounts in the last 5 to 7 years. I know from talking to people in Europe that they have looked at their portfolio construction and they've gone, oh my goodness, we are so overexposed to the United States. We actually don't really know what's going to happen next, but we feel uncomfortable having 67% of our total portfolio in the United States. So we're going to pare that back to 65, 63, maybe 61. Now, these pension funds move very slowly. They have long investment committee meetings, take a long period of time. But I hear that from quite a few people in Europe. So what does that tell me? It tells me that, you know, just be a little bit cautious on the United States. You said it yourself, the valuations aren't exactly cheap. Funnily enough, Eugene, just in the last week, I've been looking at the various sectors in the United States. And, you know, the one sector that will, I think, be one of the bigger beneficiaries of this reversal of these ridiculously ludicrous high tariffs that Trump was kind of talking about is actually smaller companies. So it might be more of a tactical play, but the smaller company index, as you know, has underperformed the rest in the last couple of months. And I think that might actually play a little bit of catch up. And also portfolio managers that are looking to try and do something now that we've got this new event, this new news out of Switzerland and both China and the United States pulling back from an effective trade embargo, you might see some allocation into smaller companies. So that looks like, I think, a relatively bright spot in the next couple of months. With regard to the Australian market, you know, we did a similar kind of thing here. We collapsed and then we've rallied, and I see a similar kind of consolidation here. Yes, the RBA cuts, but then the market's going to have to price my apologies, a fairly long pause from the RBA as the RBA digests the fiscal ramifications of a very, very large Labour majority in Parliament.
Yeah, okay. Thank you for that. And then bonds, and we've sort of touched on it earlier. What are your thoughts on bonds?
I'm still cautious on the long end of yield curves. I have been for a while. I was very much part of the yield curve steepening community. I'm kind of still on that train. I understand the rhyme and reason and logic behind a steepening of the curve because, of course, the United States has this massive refinancing requirement because they're running a large budget deficit with vast amounts of government debt. And so as we move forward, the United States Treasury has to issue a vast amount of securities to finance that continuing budget deficit. And therefore, that will put all things equal, upward pressure on particularly long-term yields. We also know that Janet Yellen, I mean, I can say this, I think, she's no longer Treasury Secretary, was very, very, I think, irresponsible in basically the majority of the issuance of US debt was in very short-term securities, namely US Treasury bills. And now we've got a situation where there's a disproportionate amount of outstanding US government debt that has very short maturities. But the problem with short maturities, they have to be refinanced sooner. And a lot of that refinancing is happening over the balance of this year into next. And wait, if you do the maths, and the CBO has done it, and every hedge fund, global macro hedge fund, has done this calculation, and I know Scott Bessent has done this calculation, that if we refinance all of this debt for the remainder of this year and into next, above 4% yields, above 4% long-term yields, your interest bill is going to skyrocket. Now, it's already $1 trillion.
Yeah. And you're going to see this in a lot of places, but I think the US is, you're going to see this, you know, for the next 5 or 6 years, unless rates come down significantly, because a lot of these loans were at, you know, 0 to 1% interest rates, right? Leading into the repricing in 2022. All right, so we're cautious on long duration bonds. So to summarize your view, you're cautious on duration. I think in our discussions, you've sort of expressed that whilst you're cautious on it, because the yields are now at sort of 4 and 4.5, and maybe even approaching 5%, depending on where you're at on the yield curve, because you're getting that yield, you're not worried about, you know, the sort of losses that you were seeing in 2022 and 2023. So it's still worth having some in the portfolio, but you're underweight, and at the very least cautious. And in terms of, is that an accurate representation of your view?
That is an accurate representation, because you and I have had these conversations over a long period of time. The great thing about higher nominal yields is your starting point is higher.
Yeah.
So it's higher. And so basically, you know, you've got more kind of cushion. If yields rise, you're still getting a reasonable coupon or fixed rate of return. So there is a greater sense of immunity to rising yields. But yeah, I'm more disposed to the front end of the market. And also, I think you can have allocations to credit. I would be somewhat wary of high yield.
Yeah.
And I've expressed that before, but I think there's an argument to be made for an exposure to you know, higher quality credit.
Floating rate. So credit that doesn't have long-term fixed yield, right? So we call that floating rate credit or short-term credit. But the emphasis is on quality. I don't think this is the time to be going into junk bonds or high yield. Our view is that we want to have investment grade, good issuers. There's probably better value in Australia, and probably the yield risk for duration is not as bad in Australia as it is in the US. But yeah, quality you want to have, and I think that's across everything. And emphasis on quality in a period where valuations are stretched. There's a lot of uncertainty around interest rates, inflation, and what governments are going to do from a fiscal point of view. Okay. Now let's turn to the lifespan managed portfolios, and just talk about some of the changes we've made and how we're positioned. Some of the changes we've made over the last 3 months, that is. Generally, the portfolios remain fairly conservatively positioned, and we've only made a few small changes since February. In the strategic portfolios, we made a couple of changes in March. We sold a decent amount of our duration holdings. So we took the view that there was some risk of yields going up, and we wanted to reduce our holding and be a little bit underweight. We also feel, as we discussed earlier, that there's probably better value in credit, and better value being with a manager that will trade what's happening around duration and high quality credit and cash. So we moved a decent holding out of our JCB Active Bond Fund, which basically invests in Australian government bonds with duration. They've got like an average duration of about 5 years. And we moved that into the Janus Henderson Tactical Income Fund. I think we put a little bit in some of the portfolios into perpetual credit fund, or it's diversified fixed income fund, which is basically a floating rate credit. But the Janus Henderson fund has a very low duration, so it's positioned to be not too sensitive on interest rate movements. And we've had both funds in the portfolio for a long time. We know what they do. We know they're very high quality managers. And so that was us essentially moving a bit of money out of duration into an environment that's less interest rate sensitive and is going to be actively managed in that space. Because of some of the concerns we had around inflation causing bond yields to increase, and some of the other factors that we've discussed today. We're also looking for a way to increase growth, but without adding to equities now. And we did that basically by adding to G-REITs, which is basically listed global property. We used an index fund for this because we're still evaluating an active manager to put in there. So probably over time, over the next month or two, we'll probably replace that manager for an active manager. It is quite an interesting asset class, and there's a lot of different managers that manage in a different way. So it's taken us a bit of time just to evaluate everything that's out there. There's also some new players coming to market. So we'll probably look at making that change over the next couple of months. On the tactical side, in February, we actually reduced exposure to duration a bit in the tactical portfolios, and we also reduced cash. Thinking was very much the same. We wanted to move money out of duration and we moved into the Janus Henderson fund as well. Same rationale as to what I said earlier. I wanted to reduce duration, given the risk that I mentioned before, and move it to a tactical fund with less duration. Then in March, we also increased. Now, if you recall, we're quite significantly underweight equities in tactical. We're also underweight in strategic, but not as much. So we took the opportunity of there being a bit of a sell-off in March to reduce our underweight position or increase equity slightly, but we're remaining an underweight position during the sell-off that occurred in March and April. But as I said earlier, we're still conservatively positioned there. But we have a view to sort of slowly bring that into line over time, depending on what happens in markets. Okay, so to summarize, we're underweight equities in both tactical and strategic. Obviously, significantly more in tactical. We're underweight duration, and we're overweight high quality credit. And some of that is through a fund that will move tactically in and out of credit. We want to, as I said earlier, we want to stay away from low quality credit in this environment. And Jonathan mentioned earlier, small cap global equity. So we've been adding a position. We've been building positions to global small and mid cap equities via they call them a SMID, small to mid cap manager over the last sort of 3 to 6 months. And again, this is on valuation grounds. During a sell-off, the textbook sort of says that small and mid caps get hit harder, but we're trying to look beyond that and also think of it more from a valuation point of view, that there is a significant difference. Plus, it adds a level of diversification to the portfolio. So that's kind of a summary of what we've done over the last 3 months and how we're positioned going forward. I feel as though we're reasonably well positioned for what's going on. We're diversified, we're underweight most risky assets, but we're not crazy underweight because there is uncertainty, and uncertainty also means it's not necessarily going to result in a significant downturn for risk assets. You've seen how quickly things can fall and how quickly they can then recover based on how circumstances change. And it's hard to predict that, but when you look at it more long term, you've got to pay attention, I think, to valuations, earnings, and structural shifts in what the market's pricing for interest rate cuts and what's more likely to happen. And we've seen, Jonathan, you've talked about this a lot. You've seen how the forecast for rate cuts has been so incredibly volatile over the last couple of years. And mostly we've had revisions, we've had expectations of lots of rate cuts, and that's been pared back to significantly less than what was originally projected. So yeah, equity markets have continued to go up right up until the recent volatility. So that's how we're positioned. Jonathan, anything you wanted to add to that, mate?
No, I not really, Eugene. I think you're right. The way in which economists and analysts revise what the Fed's going to do next has just been extraordinary. It's been one of the most volatile in terms of the way the market thinks what the market thinks the Fed's going to do next. We had 6 cuts, then 4 cuts, then no cuts, then 3 cuts, then 4 cuts. Someone told me yesterday, and I haven't had time to check it out, that Goldman's is now going for 1 rate cut in 2025. So 5 minutes ago there were 4 rate cuts. So you're absolutely right. It's bewildering. There was a lot of volatility just in what the market thinks that the central bank's going to do.
Yeah. So at times like these, when you're not sure, and it's okay to be unsure, I think we go to our best tools, which is probably diversification and quality, owning quality assets, because even if you're wrong, they're more likely to stand the test of time. And with that, we might leave it there. It's been a great discussion, Jonathan. Thank you once again. Thank you to everybody for joining us, and look forward to talking to you again soon. If you've got any questions regarding anything we've discussed, please don't hesitate to reach out to your Lifespan advisor. And if you don't have an advisor, you can contact Lifespan directly by visiting our website, and we can help you find one. So thanks again, and all the best.